Welcome to the B.F. Anderson Technical Report for September 23rd. Trend following is an exercise in observing and responding to the ever-present moment of now. Quote by Ed Sakota. Basically, what that means is that if you start getting into the business of predicting, I think you get in trouble because nobody can predict. It's kind of a God thing. However, trend following is just, let's look at where we are right now. Let's take this a day at a time. It's good advice. So trend following, we'll talk more about it as we get into the video. So the current trend on the NASDAQ, as you can see here, we've rolled over, correction in the market, broke the 50-day moving average. So this is basically on a sell signal. Just be aware of the fact that the market is no longer uptrending, making new highs, but it's in somewhat of a pullback, consolidation, correction, whatever you want to call it. However, on this graph here, which is the weekly graph, which I've always kind of felt like is the best way to look at the market, 35-week moving average, very positive uptrend. You can see here we talked last week about how maybe we kind of got ahead of ourselves here, and then we had to pull back a little bit and somewhat consolidate. Mid-cap stocks, like we've been noticing all along here for a good while, we've just been moving sideways in the mid-sized stocks. Pullback, breakdown on a sell signal. Again, we would just continue to be cautious, be very selective about your buying. I would probably, if I was looking at a stock that I wanted to buy, I think I'd buy half the normal amount I would buy. And anything that's hitting your stop losses, you should honor. New York Stock Exchange, you can see here again we had the sideways movement, breakdown, sell signal. We've got the small caps, same situation, high, lower high, somewhat in a downtrend. Small caps is difficult index to follow. Now on the S&P 500, again this has been the strongest index all year, however has now broken down, given a sell signal, broken below the 50-day. However, again, like on the NASDAQ, the longer-term picture looks pretty good. So I would say, unless we see a break below the 35-week moving average for both the NASDAQ and the S&P, I really wouldn't be too bearish, but I would be careful. Okay, on the aggression index, as you can see here, we're holding that 10-week moving average, so far so good. On the three economic indicators, interest rates continue to stay flat, pretty much boring, but we should keep an eye on it. Oil prices, again, kind of started to get a little bit of a rally, pulling back somewhat. Financial stocks, downtrend, however, getting a pop today. New lows kind of picking up a little bit. Again, this is concerning. We don't want to see an extended period of time above 40 a day. We're somewhat getting that. So again, we continue to be cautious. Now on the inverted yield curve, no inversion, actually seeing some improvement here. Continue to monitor. Now this is the big deal here. This is where we're getting a major break in the sentiment readings on the retail side. This is the AAII bull minus AAA bears sentiment ratio. You can see here we have broken down here to a reading of around minus 17. Notice here what happens is, people are greedy, then they get super fearful, and that's where the market puts in the low. Again, we get greedy, we get fearful, market puts in the low. So we've been greedy, we're getting fearful. Hopefully the market is putting in a low here. However, this is a very positive reading. It's early in the game, though. We can see this can get worse. The sentiment can get worse, but so far looking better than it has in a long time. So, but we're not. The problem is here we're really not getting a confirmation from the put-call ratio. We continue to see a high level of greed there. It would really be nice if we could get back up into this middle range. The growth stocks continued somewhat languish. We made the high back on February the 10th, sideways. Testing this area here, we continue to test it. We came down, however, we are for the first time making somewhat of a higher low at this point. It would be great if we could make a higher high. That could be coming, who knows? Junk bonds compared to traditional treasury bonds, we're continuing to see somewhat sideways action, improving but sideways. again, we're somewhat breaking down below some of these moving averages here. The ratio is not that positive. I think the market is still somewhat concerned about the activities in the economy. Now this is interesting here. What I did with the volatility index, I made a change here. I added a indicator at the bottom of the graph, which is showing the VIX, which is the volatility index. We're using rate of change, and so for the last 10 days we're using a 10-day rate of change. So you can see here we got down to minus 25, then we went to plus 50, which was a pretty dramatic move, and it's at somewhat at the highest levels it's been at in a while. So even though we're getting a spike in volatility, I think it's quickly starting to calm down, and I think we somewhat got to an excess, moving from minus 25 to plus 50. That's a big move. Now, I just wanted to talk a little bit about more on trend following. What I did here is I just took some arbitrary moving averages. I start with the 50, and I climb all the way to 250-day moving average. Now, you can see here, now I went back about 2 years. You can see here, this was the pandemic when the coronavirus hit. You know, we came down, just sliced through those moving averages, made a low in the market, then got into a very powerful uptrend. Now you can see here as we've gone along, we've tested. This is the green line is the 100-day moving average. So we came down, tested the 100-day, tested the 100-day, but since then, really only testing around the 75-day. Well, in this particular drop, this is the first time we've gotten as low as the 100-day. What does this mean? It just simply means that the trend has been somewhat broken here. However, we've been here before, recovered, started a new up leg, but this is a reason to think, long and hard about what you're doing. Now, also, all the big news about China, I thought I would just look at a couple of Chinese situations and how we would have handled them. You can see here with the 10-day moving average, we got a violation of the 10-day moving average right in here. So we would have probably been exiting Alibaba at that time. And thank goodness, because look what's happened to the stock. You can see what's happening to the Chinese stocks. Quite interesting. Now, along with that, you got Freeport-McMoRan, which is copper. So, I know a lot of people worried about inflation and so forth. The market's really just not discounting that. Now, we got the sell signal on Freeport-McMoRan right in here. We got a little bit of a rally, then we had a confirming sell signal here. Stock is pretty much rolled over. So copper prices are just not going up. Now, on the top 5, here's a company called DigitalOcean, which is a technology stock in a very nice uptrend. We got the buy signal right about in here. Stock looks positive. Keep an eye on it. Lightspeed, which is a company that's into omni-channel platforms, continues to be in an uptrend, hit an all-time new high today. Sprout Social, which is involved in advertising on the internet, buy signal here. You can see the volume coming in. Also, you had another big volume spike here. Stock continues to stay above that 10-day moving average in a really very solid uptrend. Atlassian, which is a Australian company, software company, again, buy signal came in, has been basically, this was a gap buy signal. This is like an ascending flag formation. Stock hit an all-time new high yesterday, continues to be in a powerful uptrend. Here's Asana, the other software that we're in. We also own Atlassian. We also own Lightspeed. Need to disclose that. I keep forgetting to do that. But anyway, you got your gap up here, ascending flag, very powerful, very positive formation. So that's it. If you have any questions, please give me a call. Thank you very much.